Microsoft put roughly $13 billion into OpenAI over 6 years. After OpenAI's 2025 restructuring, Microsoft's stake was worth about $135 billion, a 10x return on paper that ranks among the best corporate investments ever made. But here is what makes this the deal of the decade. The paper gain is the least interesting part. The contract is built so that Microsoft gets paid when OpenAI succeeds, gets paid while OpenAI loses billions, and keeps the crown jewels if the whole thing falls apart. Today we take the machine apart, where the money actually flows, what Microsoft really bought, and the strange clause about artificial general intelligence sitting in the middle of the most important partnership in technology. Rewind to 2019. OpenAI was a research lab that had just concluded it could not afford its own ambitions. Training frontier models needed supercomputers that cost more than a non-profit could ever raise. Microsoft had the opposite problem. Endless money, no AI story. It had missed mobile, missed search, and watched Google buy DeepMind. So Satya Nadella wrote a $1 billion check, and here is the detail most people miss. A large part of it was not cash. It was Azure credits, coupons for Microsoft's own cloud. OpenAI got its supercomputer. Microsoft got an exclusive. OpenAI would train and run everything on Azure. From day one, the investment was designed to boomerang. Money leaves Redmond and comes back as cloud revenue. Microsoft never bought normal shares because until 2025, there were none to buy. OpenAI was a non-profit with a capped profit subsidiary bolted on, so Microsoft bought something closer to a profit-sharing agreement. Reported rights to 75% of OpenAI's profits until its money came back, then nearly half of profits up to a cap. Since OpenAI had no profits, what Microsoft really acquired was position, exclusive cloud provider, a license to the technology itself, and a seat welded to the fastest-moving lab on Earth. Think of it less like buying stock and more like being the landlord, the power company, and the bank for a tenant you are betting becomes the biggest company in the world. The rent alone justifies the loan. Then ChatGPT detonated. Fastest product to 100 million users in history at the time, and every single query ran on Azure. In January 2023, Microsoft went all in. Roughly $10 billion more, again heavily in compute, bringing the total to about $13 billion. Wall Street called it a bet. Mechanically, it was a prepaid order book. OpenAI's costs are overwhelmingly compute, so OpenAI spends investor money on Azure. Microsoft books it as cloud revenue, and Azure's growth numbers, hovering around 40% with AI contributing a bigger slice every quarter, help add trillions to Microsoft's market cap. Microsoft stock gained more value in the 2 years after that check than the entire investment 100 times over. The flywheel was spinning. Now the parts of the machine nobody sees. Under the reported terms, OpenAI pays Microsoft about 20 cents of every dollar it earns. ChatGPT subscriptions, API calls, enterprise deals. Microsoft takes a cut off the top. Revenue, not profit, which matters enormously for a company that has never been profitable. And the toll road runs both directions. Microsoft sells OpenAI's models directly to corporations through Azure OpenAI, keeps that revenue, and sends a reported slice back to OpenAI. Either way, a dollar spent on frontier AI tends to pass through Redmond. When OpenAI's revenue crossed roughly $20 billion a year in 2025, Microsoft's quiet toll became a multi-billion-dollar business that appears on no product price list. The second stream is bigger. Microsoft's license covers OpenAI's technology itself, the models, the weights, the research. Microsoft takes those models, wraps them in its own brand, and sells them at enterprise prices. GitHub, Copilot for developers, Microsoft 365, Copilot at $30 per user per month, stacked on top of Office subscriptions corporations already pay for. Do the math on even 10 million enterprise seats and you get billions a year in high-margin revenue sold through the largest corporate sales force in software. OpenAI does the research and burns the capital. Microsoft ships the result to a captive audience of 1 billion Office users. It is the oldest trick in Redmond's book. own the distribution, and the technology's economics belong to you. Put the whole machine together and follow a dollar around the loop. Microsoft invests in OpenAI mostly as compute credits. OpenAI spends it on Azure, which Microsoft reports as cloud growth. That growth powers Microsoft's stock. OpenAI's models come back through the license and become Copilot, sold at enterprise margins. Copilot revenue and the 20% toll flow into Microsoft's income. And OpenAI, needing ever more compute, raises money from others. SoftBank led a round valuing it at $300 billion, then $500 billion, and spends much of that on cloud contracts too. Other people's capital, spinning Microsoft's wheel. If this circular geometry sounds familiar, it should. It is the same loop we flagged in the bubble episode. Which brings us to the catch. There is a cost, and in late 2025, it finally showed up in black and white. Because Microsoft owns roughly a quarter of OpenAI, accounting rules make it swallow a share of OpenAI's losses. In a single quarter, that charge was $3.1 billion, which implies OpenAI lost something like 11 or 12 billion in 3 months. Let that sink in. The most valuable startup on Earth burns $1 billion a week, and Microsoft books its slice every quarter and calls it strategy. Why tolerate it? Because the losses are largely OpenAI buying. Compute, a lot of it from Microsoft. Redmond eats a paper loss on the investment while collecting real revenue on the cloud bill. It is the rare furnace that pays rent to its landlord for the privilege of burning. In October 2025, the deal grew up. OpenAI restructured into a public benefit corporation, and the profit cap arrangement converted into something cleaner. Microsoft owns about 27% of a company then valued around $500 billion, the $135 billion stake from our opening. What did Microsoft trade for blessing the restructure? It gave up its right of first refusal on OpenAI's compute, freeing OpenAI to build with Oracle and others. In exchange, OpenAI committed to buy an incremental $250 billion of Azure services, a $250 billion order book, and Microsoft's license to OpenAI's technology now runs through 2032. Read that trade again. Microsoft released its grip on OpenAI's costs and tightened it on OpenAI's revenue and technology. That is not a concession, that is an upgrade. Buried in this contract is the strangest clause in corporate history. If OpenAI achieves artificial general intelligence, AI matching humans at most economically valuable work, Microsoft's rights to the technology were designed to cut off. The founders wanted no corporation, not even their patron, to own a machine smarter than people. For years, that gave OpenAI a fascinating lever. Declare AGI, escape the contract. Reports of exactly that tension surfaced in 2025. The restructure diffused the bomb. Any AGI declaration must now be verified by an independent expert panel, and Microsoft's rights to models now extend even past such a declaration with safety guardrails. Translation: the escape hatch got welded shut, and both sides now need the machine to stay a business. Now run the scenarios. OpenAI conquers the world. Microsoft owns 27%, taxes the revenue, and sells the technology through Copilot. OpenAI merely survives. The $250 billion Azure commitment and the license still stand. OpenAI stumbles badly. Microsoft keeps the models, the weights, the enterprise customers, and every Copilot product, the assets that matter, already inside the walls. And notice the playbook is being reused. In late 2025, Microsoft and NVIDIA announced investments in Anthropic, OpenAI's chief rival, alongside an Anthropic commitment to buy $30 billion of Azure compute. Same trade, second tenant. The real risks are subtler. The circular revenue we covered last episode, and the possibility that models become commodities and the toll road empties. But those threaten the whole industry. Within it, Microsoft holds the safest seat. So what does the deal of the decade actually teach? That in the machine economy, the surest money is not in building the smartest machine. It is in owning what the machine must buy and the channel it must sell through. Microsoft structured a deal where the downside was rent paid to itself and the upside was a quarter of the most valuable startup alive. then ran the identical play with that startup's biggest rival. Casinos call it being the house. To be clear, this episode is education, not financial advice. Nothing here is a recommendation to buy or sell anything, so do your own research and talk to a licensed professional about your situation. Tomorrow, The Current is back with this week's real money in motion stories, and later this week, WeWork, the $47 billion illusion. Subscribe so you don't miss it.